Bitcoin by its very nature consumes electricity. So unlike what many people assume, people working in places like Yoido, Korea's Wall Street often raise this issue. That Bitcoin has no benchmark, and that there's no way to measure its value. But in truth, no asset's future is easy to predict. In that sense, Bitcoin is no different. Yet in my view, few assets are as measurable as Bitcoin, because it has one of the clearest reference points. That reference is electricity consumption. It records the best cost paid in the past, objectively. When I emphasize the importance of cost, some interpreted that subjectively, and even criticized me for it. But what Bitcoin values above all is the provable best cost, not a subjective one. I'll explain that part in more detail later. Those accumulated costs form a visible area, and that area becomes an objective indicator. By analyzing this area in relation to market cap, we can derive a significant index. It works similarly to how we evaluate stocks. By assessing the value of a company, then dividing it by the number of shares to get book value per share, or applying a dividend model, assuming perpetual payouts like a bond, to estimate the fair price of a stock, or using models based on earnings per share. Finance provides many such valuation frameworks. None can perfectly predict the future, but they offer useful reference points, right? Just like those. The index I mentioned yesterday, when properly formalized into an index, can serve as a powerful explanatory model, but of course it requires some refinement. For example, I talked yesterday about collapse. That's an extremely important concept. If you can try to visualize the graph in your mind, this was the area, remember? If prices spike like they did in April, if they rise exponentially like this, the rectangular area under the curve becomes enormous, but most of that rectangle is just empty space. The actual cost we paid is just this tiny portion of the area. That's extremely unstable. Now that it peaked and then dropped, the current market cap and this peak are positioned like this, so they kind of offset each other out. But should we really be offsetting from zero? Not necessarily. This part is a bit weak in terms of quantitative rigor. But if we go with intuition, when the price remains stable, for a long time past spikes should be discarded. Once it's stabilized, after a collapse, it fluctuates for a while, and then settles down. That downward trend tends to last. What we need to reflect on is the collapse itself. If the world we live in was filled with rational people who studied Bitcoin and didn't panic, then they wouldn't be Homo sapiens. If we weren't Homo sapiens, but rather some other kind of species, then this is how the pattern should unfold. The area representing electricity costs would rise sharply like this, then get filled in as market cap declines, the price shoots up again, then market cap drops again, so that the spiked areas get filled in, and it continues to move upwards step by step like a staircase. But if you look at it, it doesn't look like that at all. And because it doesn't, what happens? Every 4 years or so, driven by the halving event, the price jumps by 30 times in a single surge. When the price jumps 30-fold, you'll see that the rectangular area representing the market cap is enormous, but the total spent on mining costs up to that point is relatively small. So naturally it collapses, sometimes by 80%. And in the bear market that follows, the system actually becomes quite stable. If there were no skeptics, when Bitcoin rises, people can only imagine it rising further. Then it skyrockets 100 or 200 times. After such a rise, it inevitably collapses after that 100 or 200-fold surge. Some people start thinking it's time to take profits. If a few sell-in panic sets in, the whole thing crashes, and when it does, we call it a collapse because recovery doesn't happen in 4 years. It could take 30, 50, even 60 years. Why? Because when the gap becomes too wide, countless people in between end up trading hands. And through that turnover, people who had nothing to do with building the system invest and make money, and later get caught holding the bag. The premise of the model I shared yesterday is this. Miners are the backbone of the system. Even if miners sell, those who bought directly from them, paying what was essentially the cost of electricity at the time, that was the fair market price. And those who held their coins long term are the ones who actually deserve the profit. Of course, when they sell, new investors come in and take over, and then the profit shifts to them through that cycle. The gains are distributed, but ultimately, the core contributors to the system, they see their unrealized gains wiped out in a collapse. And then a correction sets in. They start worrying about their fixed costs, and they just wait it out. But if prices shoot up 100 or 200 times in a short period, the original supporters cash out, and people with no belief or philosophy behind Bitcoin jump in. When they get stuck later, the after effects last a very long time. This kind of aftermath can last 10 or even 20 years. Bitcoin wouldn't recover for a decade or two. That's what we call a true collapse. But as many of you have seen, and as experience shows, Bitcoin surges 30-fold roughly every 4 years, then collapses, and enters a bear market that lasts 3 to 4 years, which is why it recovers in about 3 years. And there's a well-known figure on Facebook who was surprised by Bitcoin. He wasn't a Bitcoiner originally. But recently what amazed him was this: how quickly Bitcoin recovers to its previous all-time highs. He had never seen an asset repeatedly recover so fast. That's what he said. So if this was Satoshi Nakamoto's intent, he's coming close to understanding it. And that's exactly the role of skeptics. They cause early collapses, which leads to faster recoveries. That's why this indicator is quite useful. So you should take this metric, print it as a graph on A4 paper. Look at the peaks sticking out. There are not that many, but the total market cap is huge. And you might think, Shouldn't prices fall further to fill all this? But that's the wrong way to calculate it. For that part, what you're subtracting, I'm explaining it assuming you're all just amateur level audiences. So I'm simplifying things. But for professionals in asset valuation, those who get what I'm saying, they already understood. This isn't just about subtracting something out. You need to divide the area by the market cap and convert that into an index. So you build an index and at every moment, track the value of that index. Right now, you can't predict the direction, but you can tell whether it's weak or strong over time. So when skeptics do their job thoroughly, the price rises a bit, then again a bit more, and the rectangle pulls it back down. A small rise, then it gets dragged back again. Eventually, like gold, the production cost and the market price begin to stabilize and adjust in tandem over time. The producers don't suffer major losses and can recover quickly. It becomes manageable. If we average this over 1 year, you may not make a fortune, but you also won't take heavy losses, a fairly decent business model. That's how it sustains itself. But for Bitcoin to reach that level, it still has a long way to go. We're not living in a world of cats. We live in a world of greedy humans. So instead of moving steadily, we shoot up all at once and then crash. That's why the stagnation lasts so long. Even so, if skeptics don't play their role, the price climbs too high and then crashes catastrophically. It is self-destructing. And recovering from that can take 30, even 50 years. That's why when a bubble bursts badly, trust is completely shattered and it spirals into panic. Take the Mississippi stock incident, for example. John Law's scheme in France, it pushed the country into economic stagnation for almost a century and eventually led to the French Revolution. Social trust systems are fragile and terrifying when broken. So if skeptics actually do their job well, Bitcoin could also grow in a staircase pattern, steadily moving upward for 3 to 4 years without experiencing a bear market, continuously rising, with healthy corrections along the way, and maintain a long-term upward trend. But skeptics aren't doing their job very well these days. They're just not convincing. The logic of the skeptics, it simply lacks persuasion. At some point, the public stops listening. Skeptics stand outside the gates, shouting, "Don't go to Bitcoin." But the people inside the walls see Bitcoin's price rising, as Bitcoin and altcoins alike start going wild with volatility. That's when they rush toward the gates, trampling over the skeptics who try to hold them back, crushing them underfoot, and silencing them for good. Then they all rush out, and the market goes on a roller coaster ride, only to face another kind of challenge, and eventually collapse again. That's the pattern we've seen in the past. Bitcoin exists in the midst of a paradox. The paradox is this: if Bitcoin is currently stagnating, the value of the Bitcoin system is actually increasing. Even as the system's value rises, if the price of Bitcoin suddenly soars, then while the price goes up, the actual value of the system decreases. This is the contradiction that Bitcoin faces. That's what I've been trying to explain. So when Bitcoin enters a prolonged bear market, and it drags on for a long time, Bitcoin becomes significantly stronger. As it strengthens, the system stabilizes, and the value of the system increases. And when the public begins to recognize that growing system value, the price goes up. It would be fine if it rose gradually like a staircase. But if the price suddenly spikes, and then skyrockets, the actual value of the system weakens.